Hi everybody, this is Dan from Theta Trend. This video is just designed to be a brief introduction of how I analyze trades using Theta Trend and some of the risk management rules I use and the way I choose positions. So normally what I do is I start out, this is a chart of gold, the Spider Gold ETF GLD. And as you can see over here, price closed at around 161.45 on Friday, as indicated up here, and it's about 5:30 a.m., about 2 hours before the market opens on a Monday morning. I've removed the indicator that I use to define trend, but if the indicator was showing, it would be showing us that we have a short entry right now, or in other words, we're currently in a downtrend, and the stop level would be right here at this line, the 163.90. Down here what you see is average true range for the past 20 days, and I just kind of use this as an indicator. It's not part of the actual checklist that I use to enter trades, but I keep it up so I have an idea of how much price is moving on a regular basis. And below this I have an indicator that I created that is basically implied volatility, which is the green line, and 20-day historical volatility, which is the pink line. And one of the things I look at when I'm analyzing trades is whether or not the implied volatility is greater than the historical volatility. And in this case it is, and so I consider this a valid candidate to sell trades on. So if we go back here and we just look at this and we say, okay, the 163.90 level is basically, we want to be short this market, and this is our stop level. So if price closes above 163.90, we're going to say, okay, the trend direction has changed. It's probably time to get out of our trades. But for the time being, we want to be short, and this is the level that will prove us wrong, the 163.90. So now that I know that, the next step is to go over to the options chain. And I use Thinkorswim, acquired by TD Ameritrade. And as you can see here, you know, we have the full option chain listed from the weeklies all the way down to the leaps. And generally what I'm looking at is to try to sell some sort of a vertical spread with 40 to 90 days to expiration or so. In this particular case, I already have a trade on here in March, and I was sort of poking around before this video, and it looks to me like the next best trade that I would take would be in these March 13 quarterlies. And basically what I want to do is sell a vertical spread where the short option is right around 163.90, or in this case 164. So as you can see down here, what I did is I dropped in the 165, 167 vertical spread, and it looks like that can be sold for a 51-cent credit as of the close on Friday. Let's just look at a picture of that here. So in this picture you can see here 165 is where the short strike is, and then we're long the 167 to cap the risk. Price right now is trading around 161 and a penny, I guess. And that stop level that we talked about, the 163.90, is right here. So what I look at is I say, okay, the stop level's at 163.90. What is the loss that I'm going to incur today on this trade if price all of a sudden just pops to that level? And in this particular case, it looks like it's about $25 or so before commissions, obviously. And the credit on this trade that we're going to receive for selling it is 51 cents. And you can also see that down here. At expiration, the maximum credit is 51 cents. So what we're really concerned about, though, is not the credit at expiration or not the loss at expiration. What we're concerned about is today. I mean, today is where we are. It's where the risk exists. The risk doesn't exist for us at expiration. The risk exists today because that's where we are. And one of my rules of thumb in Theta Trend is that we never sell a vertical spread when the risk that we would receive today at our stop level is greater than the initial credit received. So what does that mean? Basically, that means that at this level, this is where we're going to get stopped out. We're going to take a loss here. You know, it's at $25. If you add in some commissions and a little bit of slippage, say, you know, that's roughly, you know, low 30s, $32. Let's say it's that. And so we're selling this for initial credit of 50 cents. And that $32 loss that we could potentially take is less than that amount. So this would constitute a valid trade. If this doesn't make sense to you and you have questions, feel free to shoot me a question on the About Me page, and I look forward to hearing from you. Thanks.